I think TI-Brent's going to start to trend down now. I think there's just probably potentially too much crude coming out of the US Gulf Coast, so a lot more arb fixtures. It could manifest that actually the US grades go down and TI-Brent could stay, but generally US barrels versus anything else, so Dubai or dated, I think are going to start to come off. Hi, welcome back to Trading Corner. What an eventful 2 weeks we've had. So yeah, a lot to unpack. Maybe we can start on crude. I think it's probably been fairly interesting, bit of a roller coaster. So yeah, crazy.
I think we jinxed ourselves 2 weeks ago saying it would have been boring.
Friday the 13th hit in very good fashion.
Yeah.
Yeah, enormous, obviously short covering, the rally up. I mean, the market's had a lot of time to digest that now, but the sell-off was particularly spectacular.
I thought that was extraordinary. Like, obviously the move up, I mean, I wasn't anticipating what would happen, but I guess as the market was short, the move up was very aggressive. But what took me by surprise was how aggressive the move back down was.
Yeah.
It was unbelievable.
Unbelievable, I totally agree. I mean, it's quite interesting this when it comes to trading psychology for things like this. You know, we had an underlying, arguably all year, underlying structurally very weak crude market. And so a lot of the market was positioned short in Brent, futures, time spreads, etc. All the way from, you know, I would suggest probably trade houses to the big kind of macro funds, all the kind of like the indexes that kind of track the funds, etc.
And you can see it in TI-Brent, as you were mentioning as well, like that's in contango. So the market's saying within a few months we're going to be oversupplied crude, which is quite amazing compared to like the previous kind of few years.
Exactly. It is crazy. And I think one of the signals for us was we came in both Sunday evenings. For the open at 11 p.m.
What, in here?
Into the office, you know, ready for some drama, especially the Sunday just gone, you know, with Iran threatening to shut the Straits of Hormuz, so potentially, you know, a large portion of oil unable to flow into the east. So, you know, potentially a very big structural impact. We came in and the market opened. So bear in mind, the last news we had was the Iranian delegates had all kind of voted in favour of the Strait. So at this point, I think, you know, the chances of it occurring was probably about 60%, 60-70%.
I think poly market got up to like 50%.
50%,
for closure by the end of June.
Okay, so let's say we're at 50%. We came into as I said, into the office on Sunday evening at 11 o'clock, and flat price moved up 50 cents. Off that.
That was because the IG market, the Sunday market, was up. Don't know, maybe I shouldn't be mentioning IG, but it was up it was up $5 on Sunday night.
And just all those gains totally reversed on the open at 11 o'clock.
So it's almost as if it was kind of probably the smaller money, or like people who were more reactionary, where they were betting on poly market, implying there was a 50% chance to closure of the Strait, and then they were buying on IG. But then I think as soon as like big traders came in on Sunday night, they just sold into the...
Well, exactly. I mean, that kind of shows that what we saw was a lot of short covering, and then any kind of stimulus we had to flat price, the market was selling into it. They're like, you know what, I caught a bit of this move. Structurally, I'm not bullish. So they want to sell on the worst information that comes, or the most threatening information that's coming out. So that's exactly what we saw on Sunday night.
I was surprised. I thought it. I thought that was quite rash of the market for people to come in and sell in size flat price when I thought there was still a decent chance the Straits would be closed.
But isn't it indicating how bearish the market truly is if that's what's happening?
Yeah, I guess it did in hindsight, but it was quite. Well, and all credit to the market, called it right, and it was amazing. It
was crazy, and obviously, you know, no one can have that foresight, but I think with hindsight, definitely, the market was definitely not short anymore. You know, I think all the CTAs, all the positioning data that came out definitely said that the managed money was positioned long, so it'll be interesting when that comes out next week now. But they were using the opportunity to exit any long positioning.
I would have thought that the CTAs would be more trend following, so like, a lot of it will be trend following. So as it looks more bullish, they'll be getting long, and as it's look more bearish and coming off, I think the CTAs are probably getting short again now.
I totally agree. So yeah, flat price is one thing, but deck, as you just mentioned, a totally different beast. I mean, I was trading over the last 2 weeks. I was trading a bit of structure, deck Brent against flat price. The reason for that is because, you know, there's a lot more speculation or like stopping out aggressive price action, etc., in flat price relative to a structure like deck, but they both move with flat price, as in flat price moves to flat price, and deck will have some exposure to flat price. So for me, it was a great mean reversion trade. And what we saw, especially on, was it Monday evening, when Iran decided to retaliate by bombing the US kind of depots or whatever it was, actually the spreads came off more aggressively.
That was incredible,
than Brent flat price.
I think it's like as soon as the headline was out that they'd attacked, it just collapsed.
Yeah, I have to say, I think for me it's been, maybe since COVID, I can't really remember the vol we had on the spreads then, but in a good 5-6 years, that's been the biggest sell side flow we've seen in the Brent spreads for a long time. I mean, I think the front Brent spread moved down 60, 70 cents, like absolutely wild.
Yeah.
So yeah, when it comes to, you know, that's kind of the more financial markets, etc., what an enormous sell-off. It'll be interesting to see where we go from here. It does feel like the market is kind of back to normal.
Yeah.
You know, vol's really dropped
just
back off.
It's extraordinary even to say that. Like 2 weeks, you know, since the last time we recorded this, like given what's happened and given we're now saying the market's back to normal, it's just, yeah, incredible.
Wild. Yeah, exactly. If you're on holiday for the last 2 weeks, well timed. Because I think we are exactly
unless you'd
back
left any
to
orders in, like GTC.
Well, yeah, unless maybe you sold the high.
Yeah.
No, but we're exactly back to where we were. So, you know, of course, when we had this big flat price run up, spread run up, etc., the swap contracts had to move with it. So we did see, you know, to be honest, when dated moved up, we saw a lot of profit taking, particularly by one of the major longs. Really well timed, you know, did exactly what he should have, called it very well. Got off like a lot of size kind of towards the top of the market. So it's now allowed, as the markets come back off, the market's totally balanced. It doesn't feel like there are any particular longs or shorts.
I still feel like there's just, I mean, you know Brent much better than I do, but like the front few Brent spreads are still quite strong.
Oh, they're super strong.
But then you go to like a deck, which is in contango. So like the market's basically saying we're tight now, but by the end of the year, crude's going to be oversupplied.
Yeah, exactly. Which, for now, you know, the spreads are allowed to stay here. So all the front flies are very strong. I do think as we roll forward, those flies are going to flatten out quite a lot. So the main cause of strength at the minute is still fairly strong refinery margins. You just cannot deny we're in peak summer. Run rates are good. There is the demand for crude there, and we do have utilization to still kind of make the most of. The only place or the area that had a lot of strength and is potentially starting to soften now is the US Gulf Coast. So, you know, the last 2, 3, 4 weeks they've been running like mad. So, I mean, actually one of the traders did say there's potentially an FCC problem going on now, so maybe that'll give a bit of respite. But they were, like, even if you look at APIs, drawing loads of crude, you know, even the product builds weren't anything aggressive, so they're clearing out all this product and the crude, so it really helped give that narrative of a strong summer. But is it here to stay? I'm not that convinced. But anyway, I think now going into the next couple of weeks, I think we'll probably get a lot more fixtures of US Gulf Coast into the Europe, potentially into East, because the Dubai curve is so interesting. We've got at the front a really, like for next month, July, August, a really, really weak box. So there's some kind of physical, like, unsettlement there. I think it potentially has something to do with Murban. You know, there was a bit of drama with ADNOC reducing some of their supply contracts. So yeah, I think there's potentially a little bit of covering that's going on for next month in Dubai. which might incentivize more TI barrels to head that way. But either way, I think we're going to get an uptick in flows of TI heading out everywhere. So yeah, I do think, I mean, I said this 2 weeks ago, spectacularly wrong, but I think July, August are short still. You know, if you avoid the kind of noise in the middle, we are back to where we were 2 weeks ago, and I do think it provides a good shorting opportunity, but you have to be wary of the margins.
Yeah, so then from the product side, like margins look decent, and like when in war scenarios, it tends to be diesel that rips.
Yeah.
So that's exactly what we saw on the Iranian stuff.
A lot of stop outs there, right, on the diesel?
I think a lot of people, it's a normal short, so a lot of specs, because you have airlines buying jet fuel and distillate cracks, you need a big spec short to offset that. So both refineries and kind of spec traders tend to sell distillate cracks, particularly more deferred cracks. And normally that's quite a nice trade. Normally it rolls down. You need to be paid to be in the trade to take off the risk from the airlines. But what you do also see is when people stop out, it can be quite violent because everyone's short. So you get kind of stops triggering stops. And that's exactly what we saw. So we saw a really violent move up in the cracks, and we heard of lots of stop outs, myself included. And then also an equally violent kind of move back down.
Okay, so relative to 2 weeks ago, how are we sat on the cracks?
I reckon not 100% sure, but I reckon they're slightly higher than they were.
Okay.
But they probably went up like at the front, maybe $3 to $4, and they've come back down again. So it was. Oh,
what a ride, right?
Yeah, crazy. And that from the refinery margin side, that just because diesel's a big chunk of the margin, that inflated refinery margins, and I think it kind of pulled up the other products with it.
Well, yeah, that was the other thing. We saw so much crack hedging when all of this noise was going on. You know, a lot of the banks, a lot of I think some funds were actually selling some products versus dated cracks as well, all in the second half, and they did well to do that. They locked in those really high distillate cracks. I think some of the fuel...
What, selling?
They were selling the product cracks into dated. I think some of the fuel cracks as well they sold. So
great moment to hedge. I mean, we heard I presume some refineries came out and hedged. We heard lots of producer, they times that, so crude producers hedging, like selling deferred flat price as well. So like a lot of, from the consumer side and the producer side, sounds like people kind of timed it quite well. Yeah,
it's exactly what you should see in the market. You know, using the opportunity to lock in.
But it's hard to know though. When I initially heard like people coming out and selling, you know, flat price, like I thought that was a bit rash because like.
Well, yeah, you saw
it could have gone up.
Exactly.
More.
I mean, if we look at, you just isolate what happened with Russia, Ukraine, we could potentially have been in that situation again. And you know, I think that was a way more aggressive bull side move, but we did have a structurally very strong market at that time. But no, it'll be interesting. I think, you know, and it's been a big discussion for us on the floor as well. It's what capacity do we have here for the refineries? Is there excess capacity to start pulling out more product, or are we maxed out? Because that's really what is going to drive these product cracks and the margin for the next couple of months. I mean, we can have a situation where crude is weak and products are strong, and there's no upside to margins, right? Because everyone's hedged, there's no more sell side flow. That could be a reality, and it's exactly what we saw in 2022. Enormous margins, refinery utilization was totally maxed out. I mean, in that instance, crude was actually fairly strong as well, but it is possible, and we have been in that situation before, but I personally don't think that's the reality this year. I think we will see generally a sell-off across the board.
I agree. I mean, I still think, like, I'd actually expected margins to weaken by now already, like as we came into the summer, like refineries come back from maintenance and you move to max runs. So like, I thought I expected to be in a weaker margin environment, and I thought they would have come off.
Yeah,
but I still think there's time.
I think we potentially could have if we hadn't had this.
I think Spain did a lot as well. So like the Spain refinery outages, I think that took a lot of products off the market as well.
Right.
And
we are, you know, heading into hurricane season, you know, which could hit either product or crude, you don't know, and potentially like much warmer weather where refineries don't tend to do that well. You know, it's hard to operate such huge machinery in temperatures of 50
particularly
degrees.
FCCs. So like FCCs struggle in really hot weather. So you can't run them as hard. So yeah, that can be bullish gasoline.
Yeah. So what do we think? Do you think we're in an oversold, overbought, or balance?
Depends where. So like, I don't think the front few Brent spreads are oversold, but I think maybe deck's oversold. Like I personally don't mind being kind of long deck negative, and it's probably like minus 25 cents now.
Yeah.
So I think depends where it is, and I mean the product crack boxes are unbelievably high deck. So it's a complete disconnect. So the crude market's saying it's going to be oversupplied, and the product market's saying that there's not enough product. So the product traders are buying the product spreads, and crude traders seem to be selling the crude spreads. So like, it's basically saying there's not enough refinery capacity at the end of the year. So it's whether or not you believe that is true, and it's hard to know. But like I suspect that product spreads are probably too expensive relative to the crude spreads, and that we're not that under supplied refinery capacity.
I personally would agree with you, but I don't know if it's probably more the product spreads are too high rather than Brent's too weak. If we still continue with, OPEC still coming out with extra production, and
you might well be right. And I mean, the crude market's done quite a good job calling it the last few weeks. So maybe.
Well, let's see. But okay, maybe we can just jump into the trade ideas. What do you reckon? Next 2 weeks.
I'm sticking with. So I've been long really deferred. So deck 26 gasoline, and I took half off. That's now come back off, not right back to the lows where I initially got in, but I'd be looking to buy that back. And I'm not advocating it yet, but at some point I'd potentially sell diesel cracks against it. So you basically end up long. It's called the Widowmaker in the product markets because so many people have blown up on it, including over the last week. I think a lot of people blew up. But you're long gasoline versus diesel, which typically tends to do well as you head into summer. So like, not doing it yet. I'm just sticking along the deferred gasoline, adding back what I take a profit on, and then kind of watching Distillate to maybe sell some. Okay,
nice. So for me, I'm going to go short Brent structure. So probably in flies, Sepok North Brent fly especially. I think that is a short over into next month. Deck June deck, I also quite like. I think anywhere, if you can enter 40 cents or higher, you should be looking to pick that back up around flats and probably trade within those levels. And then the last one, I've got 3 to say. TI-Brent. I think TI-Brent's going to start to trend down now. I think there's just probably potentially too much crude coming out of the US Gulf Coast, so a lot more arb fixtures. It could manifest that actually the US grades go down and TI-Brent could stay, but generally US barrels versus anything else, so Dubai or dated, I think are going to start to come off. Structurally weak crude, I think will persist.
Cool.
Okay, let's see in a couple of weeks how we're doing. Thank you.